Well, after dramatic moves in markets after the US CPI hits the tape, resulting in a surge of volatility and pushback from the Bank of Japan, we are seeing some calmness as we go into the options expiry. But with the Fed meeting next week and the Bank of England meeting next week, is this the calmer before the storm? That's what Blake and I are discussing in the trade-off. Well, hi, my name's Chris Weston, Head of Research here at Pepperstone, and I'm going to be joined in 2 seconds by Blake Morrow from Forex Analytics. And you can see here, we've got an action-packed show once again as we go through markets and look at the setups, the various news flows that are on our mind, and we assess the risks and the trade-off that's coming through in the market. So I'm going to bring the great man into the program, Mr. Blake Morrow. How on earth are you today?
I'm doing great, Chris. Good to see you, my man.
Yeah, it's a good time, and it's a good time. We've got a lot to focus on as we go into the week ahead. Obviously, I want to talk about last week because we in the show last week we were sort of peddling this idea that there was a high probability of a bit of a tactical sell-off potentially coming through in the US dollar, and that could lift equity markets further. Obviously, the CPI number changed that. So for me, what is really important here is the ability to react. Now, we knew that there was a CPI number coming up. We knew that it had the potential to throw massive volatility. We looked at the playbook and the distribution of outcomes that could come through, and we said, well, we need a weak number. We need a 7 handle really on the headline CPI number, and that would validate this kind of positive move we've been seeing. Didn't happen. It tells me time and time again, when you get something that's so significant to the market, so significant to the Fed, these are the sort of moves that you just potentially want to look at reducing your exposure on. What did you learn from that?
Well, yeah, that's exactly it. A lot of times I go into a news event, a big news event like this, and I don't do this often, Chris. I went neutral, all cash. Usually I always have something running, but I went all cash, and that is not normal for me, because a lot of times after news, you get the FOMO, you get the regret of not being in it, or, I'm in this trade and I should have gotten out, and, why didn't I just take profits when I had them? And I actually did, went by the playbook, pulled everything off, and then reacted afterwards. And I think that showed, and it proved to me, because I would have given back everything. I would have given back everything I made over the last week and a half, really, in that one, 10-minute block of time right after the CPI release. So it just told me that, hey, we even if the market's leaning into something, it's not guaranteed that we're going to get the result that we're looking for. And that was a case in point.
Well, they call you Mr. Yen now, but they always call you the man who's always in the market. That's obviously changed. He's the neutral guy now. So, anyway, so Mr. Yen's in the house. We're going to be talking about the yen in a second. Anyway, let's go into Topical Funder and see what's going on in headline news. Blake, one of the things we did talk about, we talked about CPI just then, but one of the things that came out after that was the idea that the Federal Reserve could go 100 basis points. Sticky inflation. We talk about inflation in a second in a subject very close to your heart, but we're looking at the Wall Street Journal now, Nick Timiraos, the idea that we were in a blackout period now. There's no more Fed members who are going to be speaking up until next week's Fed meeting. So it's really down to him as the mouthpiece of the Fed, effectively. He came out with an article recently that said the Fed were going to raise by at least 100, by at least 75 basis points. The markets, if you put it now, are running about a 25% chance of 100 basis points. So they are opening the door for 100 basis points. The default position is still that we're going to get a 75 basis point hike next week. But Nick Timiraos, we've got our eyes on his Twitter feed, any kind of articles coming out that, just to see if he does say, it's more likely to be that, because then the market would obviously discount that. You're going to see the terminal rate moving up, which we can talk about in a second. The dollar's going to rally. The equity market will take another leg lower probably from that point. But that's what we're debating here. So knowing what we know now, after that CPI number that we saw, and we can talk about in a second, are you in the 75 basis point camp? Are you in the 100 basis point camp? What's your view there?
75, and very unscientific. So let me just make sure I throw that one out there. No, and here's the reason why, and we're going to talk about inflation here in a moment. but really the number was skewed by rents, and I do happen to live in one of the hottest real estate markets in the United States, and I know rents are actually starting to come down here, and so I think it is a lagging indicator. So I do, and again, I don't want to get in the inflation conversation just yet because that's coming up next. However, I will say that I don't think the Fed's actually going to. I don't think the Fed's going to move by a full percent. And here's the other reason why. Nick is also known as the Fed whisperer, Chris. And so if he's out there talking about it and we don't get it, and we only get a 75 basis point hike, the market's going to celebrate that. I mean, as crazy as that sounds, isn't that crazy? I know we said that last week, but it's crazy.
Yeah,
right?
I know. But this is the thing, right? So if you go out to people who are new to trading, and this is the conundrum, right? So you go out, we get a 75 look, scenarios, think hypotheticals here. We get a 75 basis point hike from the Federal Reserve. The day after that, we get the Bank of England coming out, and they raise by 50 basis points. And the pound just goes whoosh, right? You know, or just goes completely nuts. It's about understanding what's being priced in. So we're pricing in an element of 100 basis points. The Fed goes 75. You know, the dollar effectively sells off in that situation, right? The Bank of England only go 50 basis points when the market's pricing in a chance of the 75 basis points. Obviously, the pound falls in that situation. So in this 24-hour window, you could see some major moves, and everyone's going to be saying, hang on, they've raised by 75 basis points, but the dollar's sold off. Why? You know, it's really about what's being priced in. So you've got to understand what's being priced in. And actually, for me, what's more important is what the market price is as the terminal rate.
And we're gonna get to that point in just a minute. And I'll tell you, Chris, I love FX. And FX is the place to be. We talked about it at the beginning of this year. This is the market you want to be in. And we're talking about it. We're in it. We're trading it. And I'm glad to be here. And I hope you guys are too. So let's talk about inflation. And I gotta ask the question, Chris. I mean, everybody was calling the top of inflation. I mean, the market was leaning into it. If you sit back and
frustrations.
Oh my gosh. I mean, everybody's like, what do you mean? You know, US equity markets are down 4%. You know, NASDAQ was down 5%. Why? And it was really just positioning. Everybody was thinking that the top was in for inflation. Everybody's trading into it. And we were in that mantra. We were talking about the top might be in for the dollar, and we were there. And what happened? You know, we got this really hot August print. And I got to ask, is the top in? I mean, because the rents was a big number. It was also some food items, you know, groceries, but you know, we have crude that's come down, and price at the pump has really come down. So I gotta ask you, do you think the top is in for inflation now, Chris, or are we still going to have months ahead of pain as consumers globally?
It just feels anyone just making that call has been burnt so many times, but I don't think you're going to see a huge amount of upside from here, to be honest. And you know, we're really focused on what was going on in headline inflation, but it turned out that the one measure that we really want to look at is the sticky prices, the core inflation read, which was about 40 basis points above where the market was looking for. You make a really good point that it was really the sort of shelter components and the owner equivalent rents that really sort of drove that. Rents were up.
Medical costs.
Yeah, well, rents were up 70 basis point month on month, so that sort of drove the moving core. So look, I just don't think, the concern that we had was that the market was just saying, look, we need to see the peak inflation narrative play out in this print. We didn't see it. And there was a lot of frustrations. People had to unwind positions. Yeah, the market went down, and you've got a lot of optionality that goes through. The market suddenly, dealers were short gamma. They were having to hedge by selling futures ahead of OPEX this week, on Friday. And it was just a lot of positioning that unwound. We saw volatility kick up. The volatility targeting funds were dumping positioning left, right, and centre. It was just a bloodbath coming through. That positioning was just an exercise in understanding flow. But I think there was just at the heart of it was this frustration that people were positioned for a peak inflation narrative and it didn't come. And the core number actually was going the opposite way. So I think what's really interesting here is that the Fed, in some people's eyes, would say have increased the capabilities or increased the possibility that they will raise rates until something breaks now. That they will not just raise rates and cause a recession, a shallow recession, but they will actively welcome a recession. That's what probably changed in the market's eyes, I think, based on what we saw from core inflation. So there was a psychological change that I think still needs to play out in markets. I think one of the other things, if we take a switch for focus, was that we did obviously see the dollar rally. And there's no better place to hedge yourself than in the dollar. So we're talking about the Bank of Japan because really, the Bank of Japan, they stepped it up yesterday. Their Bank of Japan really, really stepped it up. And the dollar was the place to be. You had to be in dollars. Equity market drawdown, buy dollars because it's the best hedge you can have against drawdown. It's got the most inverse correlation against equity markets. So equity up, buy dollars, and it's sort of self-perpetuating loop. But of course, we saw dollar yen pretty much touch 145. The Bank of Japan, you saw the finance minister coming out. You saw the key currency member of the Bank of Japan talking about intervention. This idea of checking rates came through on the wires, and everyone went, whoa, this is really it. This has preceded intervention before. They are calling up the banks and saying, give us your bid on dollar yen at the moment. What are you good in size? And everyone said, this is it. We've got to get out of our yen shorts in this situation now because they are really meaning business. Does it mean business for Mr. Morrow, Mr. Yen? Or is this a buying opportunity in the yen crosses here?
Well, it means I believe it means business because you got to go back to this harkens back to the 90s. When you talk about getting rates checked by the BoJ, the MOF, and when you have Suzuki out there checking rates, they're meaning business right now, Chris, and this could really shift the gears, in my opinion.
Is that a pun?
Because
is that a pun? Suzuki.
It is.
Anyway.
It is a pun, but it could shift gears here. The reason why I say that is because the yen has not been correlated with risk at all.
No,
for and for good reason
It's been driven by the bond market, so it's just a bond proxy, right?
Yeah, it's just yields go up, and I mean, look, you got 30-year yields that are touching trend highs. I mean, you got the 10-year yield doing the same thing. Yeah, well, of course, you just buy the dollar yen. But this might actually shift the narrative where the yen becomes more of the risk-off proxy, and where the dollar and the yen start to share some of those, some of those traits like they have in the past. Because people now start to get worried. Well, maybe I won't be buying, all dollars. Maybe I need to be a little careful with owning dollars up at these levels. Maybe I'll just buy the yen because I've got the BoJ and the MOF holding my back. So that's kind of my thoughts, and I'm glad I'm actually buying and getting long yen at these levels.
Yeah, they've stepped it up. I still think we're away from intervention personally, but what they've done is they've gone out to the street and said, you want to hold a big yen short position, think twice about that right now, because you know what? If we come out and we start buying yen, we start selling our reserves, you're going to see a 400-point move off the bat to the downside. And do you want to be involved in that? Because there's going to be some massive slippage if you are. So what they've done is they've caused a massive element of doubt in people, hedge funds especially, who have been shorting the yen for carry purposes. Volatility adjusted carry has been the strategy du jour. Everyone loves that right now. It's been the best performing strategy, and the yen's been right at the heart of that. They have just really gone out to the street and said, do you want to be involved in that vol adjusted carry trade? Think twice about that. And that's really, they planted a seed of doubt. And I think that's going to ward off a few people. So, yeah, well done to them. But I still think there's going to be people looking to buy dips for now. Let's talk about buying dips, but let's talk about different markets. Let's talk. Right, yeah. Great segue, Chris.
Yeah, it was. You're good. Right? You're really good. You're really good. I'm going to talk about risk markets, and I don't want to talk necessarily all about the S&P. I mean, I want to talk about all other markets. If you remember 2 weeks ago, Chris, I kind of built the case about how the markets might stall at the 200-day moving average, but it's not just the S&P. It was the NASDAQ, the DAX. We looked at the CAC 40, or we talked about it. We talked about all the other markets. So I want to talk about the markets broadly, because we have seen that correction, and we are going into a kind of a tricky area or tricky time in the markets. Seasonally, you want to be buying usually risk sometime in November, but this fall, it's like, do you buy Like if I had to ask you, where's the next 10% move? Is it higher or lower from here? That's the debate. And it's not necessarily directed all at the S&P. It could be, at the DAX or the CAC, whatever risk assets you want. But we have rates going up globally, right? We have inflation that's going to run, where everybody's bracing for a very, very tough winter, especially in Europe. And, we still have a conflict happening in Ukraine. And, everybody's got their rate expectations going up globally. But how about, if economic data starts to weaken, we start to see employment data worsen globally, is that going to be a trigger for like rhetoric to ease off from all these central bankers?
I think the Fed wants
so
this.
It's kind of tricky here. What do you think?
I think the Fed want the recession now. I mean, they need to do something. Something's going to break further down the line. They're going to raise rates, and they've seen that with inflation. If you put a Morrow metaphorical gun to my head and said 10% upside, 10% downside, what's the most likely scenario? I say downside right now. Why? Because as I talked about there, I think the Fed actually will welcome certain softness in the labour market. I think they're going to cause something to potentially break. And I think your reserves are about to fall quite precipitously as balance sheet reduction comes through, and markets have been very well correlated to that. So I think for me tactically, there's probably more likely we're going to get downside than we're going to get upside. But I've got an open mind and I'll react to that. That's my hedge against that scenario. But that's where I think it is.
So they're trying to engineer tighter fiscal conditions or tighter financial conditions, right. And one of the levers is the equity markets, right? Risk.
The concern you've got as well is the dollar, right? So as the dollar strengthens, it has this kind of effect into global central bank balance sheets. So as the dollar goes up, central bank balance sheets fall, and effectively that tightens financial conditions, and it impacts emerging markets quite negatively as well because of the dollar liabilities. So I think we're at the centre of this. It's not just real rates and terminal rates, but it's the dollar. So if the dollar rallies, nicely from here through, into 115 on the Dixie, then I think risk goes down. So that's probably the one of the aspects that I think everyone should have as a central focus is what's happening with the dollar. So liquidity is coming down. We know that. But I'm not saying we can't rally 10%. I just think if you're going to say which one is more likely, it's probably downside. Interesting. Put a comment in the comments field. I know a lot of people have probably share my views. A lot of people would disagree. Put a comment in the comment field. Let us know what you think in terms of where you see the most likely scenario. I'd love to hear what you've got to say. Anyway, let's go to that's a setup to see what the setups that were on our mind at the moment. Blake, school's back. I'm going to give you a tidbit that I like to use. We're going into the trading view charts at the moment. What I think is really important for the dollar, for equity markets, is what we call the terminal rate. The terminal rate is the highest point in the Fed funds future that the market is betting that the Fed will get to in terms of their interest rate setting going forward. And what I've actually done is I've taken the April contract, which is actually the highest point. It's the highest yield that we have. And the equation that you can go into TradingView is to type in 100 minus ZQJ 2023. So that you can see in the top left there, that is Fed funds trade at a discount. The price trades at a discount to par. So effectively you're taking away. And what that will do is give you the yield for that. So this is effectively the expected interest rate that the Fed will have through this period. That's the situation. So what you're doing in a nutshell, in layman's terms, is if by using that equation, you can see what is the highest point, what is the market expecting at the highest point, and that's the April contract. So we're pricing now that the Fed funds rate will get to 4.38 or nearly 4.4% by April next year. As that's going up, as interest rate expectations are going up for that period, you can see I've overlapped that against dollar yen, and you can see there's a pretty good relationship for it. So as the terminal rate's going up, the dollar's strengthening, equity markets are going down. This is one of the most important charts in macro. It's not about what's being priced necessarily for the September Fed meeting. It's what's being priced at its most at the peak, is what we call the terminal rate. And so that is the chart that I use to do. And you can see the dollar's correlated to it. So if we go up to about 450, the dollar's going higher. So that's what I look at, Blake. Any thoughts on that one?
Well, first of all, I think listening here to the trade-off, you learn something new every session, and I'm learning something new from you, Chris. So I appreciate that. And I'm sure if you all are appreciating it, make sure you give us a thumbs up if you're watching us on YouTube, and give Chris a thumbs up for this. And you try to think about how we get to the terminal rate at 4.3%, or maybe even 5.5% if it continues higher.
Whew.
75, 75, 75 gets us not even there. Whew.
A world with
Right?
over 5% Fed funds being priced in is a world where dollar yen is probably trading well above 150, in my opinion, where euro dollar's trading into 95 cents, cable's trading into 110. So yeah, that to me, that this terminal rate, get it up on your charts, because if that, we all keep saying it's priced in, and as you can see there from the candles, it keeps going up. So the terminal rate for me is really important.
Awesome. Well, we wouldn't have a good show if we didn't look at the S&P. So let's take a look at the S&P, Chris. And this is how I'm looking at it. First and foremost, we have a descending channel. You guys know that I've been looking at a head and shoulder pattern. I didn't draw it up on this chart because this is an actual Pepperstone chart. So I actually left it alone. But that head and shoulder actually points towards 3,400, 3,500, depending on how you draw it. But the question is, how do we get there, and what's going to tell me we're on our way there? Well, we are holding channel resistance. We held the 200-day moving average. If you look at the lows that were posted back in mid-June to the high we had in mid-August, so that 2-month rally that you saw, the 618 or the golden fib level comes in right at 3,900. That is basically the lows that we were probing at last week, but we held. So what I'm going to be looking for is if that trend line, that ascending trend line that connects the lows, and that 618 retracement right around 3,900, we close below that, Chris, I think we are going to see lower levels going into the fall. Now, I'll be looking to play it in two ways. I'm going to be playing it on the short side as far as risk goes, and then I'm going to be looking to play it long towards the lower end of that channel going into the fall. So how do you think, and what do you think of this chart, Chris?
Yeah, I mean, I'm looking at the signs of what's going to make it go lower. For me, it's reserves, it's liquidity, and as the Fed balance sheet falls, the reserves on the liability side will fall. It makes a mockery of the fact that markets live in the future when we're so correlated to something that's happening here and now and only comes out once a week, which is the reserves, the balance sheet effect. But if we break this trend support, then I think I know what's going to cause us to go lower. I don't know whenever it's actually going to happen, but if the market starts to warm to that, then I think it will just really increase my conviction that to trade this on the short side for a move down to the June lows. So I think that trend's probably going to get quite a lot of look at. The retracement level that you talked about may get quite a lot to look at. But if this starts going down, post options expiry this week, this Friday, a lot of that gamma will roll off, and that may relieve us to a clean structure, and that's usually quite positive. But the price is effectively the final arbiter of truth, right? So if it's going down, and we know what's causing it, I'm going to be trading this from the short side with a higher conviction. Another chart. Let's go to gold, because gold's found something similar. If reserves are coming down from the Fed's balance sheet, generally the dollar's going to be going up. We're probably likely to see real rates moving up, and one that is probably well correlated and will move on the same reasons as the S&P as the gold market there. You can see we've got a bear flag pretty much in play. It hasn't broken that channel support, but it needs to do so. And then we've got those lows that we've been seeing really since 2021. I mean, if we could take that chart out and have a look at it on a weekly basis, you'd probably see it better. But 1678 is your line in the sand. 1678, 1680 is your line in the sand there. If we break through this bear flag, then obviously that increases sort of the weight of capital and the conviction that we're going lower. If it breaks through that 1678, good night Vienna. We're trading to the bottom end of the channel. It's going to be working on the same thematics as the S&P, in my opinion. So, similar situation. Poor liquidity. Crypto may actually work better to the downside. We'll have to see that one happens. But all the same thematics driving. Liquidity, dollar, real rates. Blake.
I first got my securities license, my Series 7, in 1995. First time I sat down at a trading desk was in 1996, November of 96, actually. In my career, Chris, I've always known gold to be an inflation hedge. So I don't know in what world I would never have thought, here we are in 2022, we have inflation running what it's running right now, not only in the US, but globally. And you have gold that looks like we're about ready to break a multi-year low. It's crazy to me, but I don't know what positioning's like in gold, but that is a bearish wedge. And if we crack that 1678 level, good night. I'm with you. That gold's going to be trading down towards the 1500. I think it's going to have a 1500 handle. And I can't believe it. I still look at it and I still scratch my head almost every day that I look at gold. But it is what it is.
Inflation expectations are running pretty sideways. Bond yields, nominal bond yields are going up, so real rates are going up quite sharply, and that's just killing off the dollar, killing off the gold market. Everyone's saying gold's a recession hedge. Well, we're probably likely. Maybe it works when we see clear signs that the US is going to go into proper recession. We'll see. But right now, there's an opportunity cost, and for me, the most important thing remains reserves and liquidity, and that's hurting gold at the moment.
Yeah. All right. Well, I'm to be frank, I'm surprised we're not trading a little bit lower here as we're filming. Let's go ahead and take a look at now. I'm gonna take you over to wheat, and let me first of all say that I've never traded wheat before, Chris, but I'm doing this for you. I'm doing this for you, and I'm doing this for you and the viewers here at the trade-off.
Well, if you're Mr. Yen, you're Mr. Yen, I'm happy to be coined Mr. Exotic. I'm happy to go that
You
way.
could be Mr. Exotic. I like Mr. Exotic. That could be your name. But what I'm looking at is this nice rounded bottom that wheat is formed. And when we start getting towards the resistance, which I would say is around the 200-day moving average, what I start looking at is the daily sentiment index, and that's something that our company subscribes to. I look at it every day and I see it, and it's only running at 60 tonight. I checked the last reading. It's at 60. It's nowhere near extremes, which means it could actually take off. And when you see a rounded bottom like this and this accumulation that we're seeing in wheat, that tells me that we're probably getting close to taking off. And I think above 900, then you look for a break at the 200-day moving average, then you might get an accelerated move higher. What do you think about wheat and this rounded bottom that we see here, Chris?
Love it. Absolutely love it. And, as I talked about before, we talked about this on Play of the Day. It didn't really work out at the time. The propensity to trend is what you want. But don't fight the trend. Go along for the trend, because when this trends, as you can see in that move that happened between sort of May and August, these can trend really well. So what you might do is you get a lot of false starts where you're going to get stopped out for hopefully very small losses. But when it goes, you're holding. Adopt a systematic approach. Whether it's using a moving average system, a crossover 3s and 8s, for example, or whatever you're using, use a systematic strategy, because if this goes, you want to be in the trade. You might get cut out, but when this goes, just stay in and let the system just ride it up there, because the propensity to trend in wheat is very strong, and that's what you want to be involved with. Don't get out because your emotions are telling you. Let the system do the thing. So adapt a systematic approach to trading wheat, and if this is to go based on a pattern that you've got, stay in it and enjoy the ride. I think is probably the best way to look at that. Anyway, let's go to Play of the Day. Let's see what we're thinking about in terms of the primary trades here. Well, Blake, I want to take some inspiration from your wheat idea and look at something which also has a propensity to trend, something with a bit of momentum. So I want to have a look at dollar against the Norwegian crown. Now, you can see here that we've seen a massive candle after the CPI number. We sort of a bit of indecision in the follow up. You can see that sort of doji coming through. It tried to take a new high. Market said no, not so sure. I want to put a stop loss. You can see there just on the horizontal line. I think it's the 988 or so. And really, I think if this is going to go, we're going to see a continuation of the move we saw from mid-August. Obviously, going into the Fed meeting, we do know that there's quite a lot being priced for the meeting next week. But if we are going to see a sell-off in risk, this uptrend that you pulled out with the S&P, the highest beta FX pair in G10 is dollar NOK. And you will see a bigger move in the Norwegian crown relative to any other currency if we see another risk-off situation. So if you're bullish, I wouldn't be touching this trade at all. But if you do believe that we're going to see a break of that downtrend on the S&P, then there is probably nowhere else better in G10 to be than the Norwegian crown. You are going to see a bigger sell-off coming through there. And so I think if this kicks up, which I think it looks like it probably will do for me, I think the balance of probability is higher levels. I'm going in for this. In a similar situation as you saw from wheat, I think the propensity to start trending here is very strong.
That's I like the chart, Chris, and I'm gonna tell people at home, Google yourself, see how much equities the Norges Central Bank owns. You'll be stunned. All right, let's take it over to the Canadian yen. The Canadian yen is actually my play of the day. And I'm going to just say, for the record, I am short, and I'm short near the highs. I'm short above 110. And I'm looking to add, but that's key when you're trading an ad trade, is you're looking at it as from the eyes of somebody who's going to take a fresh, brand new trade. So for me, as I'm going to add, that means I'm going to be adding to an already profitable position, but something that I would take even if I wasn't in a position already. So the the Canadian yen, as I explained to you, I am playing yen to the long side. If you look at the euro yen, pound yen, Aussie yen, New Zealand yen, dollar yen, they're all that we have a lot of false breakouts and reversals. The Canadian yen has not played catch up yet, but I believe it will. So a break back below the 107.20 level, that's going to signal to me that we got a false breakout. A lot of people have been playing this range expansion, double bottom, move to new highs. We came well short of those targets. Now we're reversing. And so I believe there's going to be a lot of stops below 107.20. Yeah. And that's how I'm looking to take advantage of it, Chris.
Yeah, good. I like that as well. Yeah, false breakouts. We talk it time and time again on the show. Usually some of the most powerful trades to be involved with if people have to reposition and get out of the trade, and perpetuates the move. So great trade, like that one a lot. Anyway, thanks to everyone who's been watching the show. Now, if you could hit the like button, we'd love that. We'll leave the comments. We talked about where the S&P is going, but any of the other trades that you've thought of, whether it's to do with Fed policy, whether it's to do with gold, Blake's play of the day, leave your comments. Tell us what you like, and we'll see you more for next week in the trade-off.